Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph show. As we continue our credit series, we're going to wrap up a portion of that today, and that portion is, we started talking about how to build credit the right way, and we're in part 5 of this, and I just want to take a little bit of time today and discuss the whole idea of secured versus unsecured loans. Because a lot of people don't understand this, and I see that, when they come in for a loan or they're talking about what's going on in their financial life, and they don't really understand the difference. So it's not a complicated concept, but it's something I think we need to talk about. And it's really quite simple. A secured loan is something that's backed by an asset, something called collateral. The best picture I can give you of this is, I remember as being a little kid, I think I went to my grandfather and I said, "Hey, Grandpop," I think I called him Pop-Up actually. I said, "Hey, Pop-Up, listen, this new video game series," and I'm going to date myself and say Atari is coming out. I was like, "What is an Atari?" My grandfather never understood. You put those quarters in that thing and it doesn't give you anything back. Not to sidetrack, but I remember going to the Christiana Mall as a kid, and my grandfather gave my sister and I each $2 and said, "Now listen, I don't want you to go to waste that in the arcade." Well, as soon as he walked away, where did we go? To the arcade. And about 7 minutes later, we were broke and we were trying to find him. But anyway, the whole idea here is it's backed by some collateral. Something is standing for this. For example, the best example of this is a car loan. You've got this car. This is your collateral. Oh, what I was saying as I get back to this discussion, I said to my grandfather, "I'd really like to get this Atari system." And he says, "Well, I'd be happy to give you a loan." And he was teaching me a lesson I didn't even realize at the time. He said, "But, what collateral do you have?" And I looked at him like, what in the world is he talking about? Collateral. What's collateral? My grandfather, Pop-Up, said, "Well, I need you to give me something to keep while you're making these payments until he says, so here's what I'm going to do." He says, "I'll buy you the Atari, but I'm going to keep it until you pay it off." It's kind of like a layaway program. I was like, oh boy, this stinks because, my friends have got this Atari system. They want to start playing it. Boy, I am dating myself. But anyway, what's the new one today? I don't even know what it is today. My kids play it, but whatever. I'm dating myself. But anyway, I get this Atari. So he was teaching me a valuable lesson. You're saying, wait a second, you want to get this Atari, that's fine. When you pay for it, you can have it. Now, of course, secured loans don't really work that way because, you're not going to go buy a car and say, "Listen, you keep the car on the back lot and in 4 years when I paid it off, I'll come and get it." Well, that just doesn't make any sense. But the key to this is with a secured loan, the lender assumes minimal risk. Because the truth is, if you miss a certain number of payments or you default on the loan, the lender can take the collateral to recover. It's your repo men. It's the guys who are lurking out in the middle of the night looking for that car because you haven't made a payment in 6 months. They can take that collateral to cover what is owed to them. And that gives the lender some assurance of risk. That might not be 100% because, a lot of lenders will give you 100 or 110% of the value of that car to loan on it. And if you default, first, second, maybe 10th payment, you may be upside down or what they call underwater on that loan because of depreciation. But it still gives them something they can go after if they can find it. Other types of secured loans are mortgages and home equity loans. Both of those using that home as that asset. That's why they're going to do an appraisal and they're going to say, okay, what is your house worth? And they may only lend you up to 70% or 80%, or maybe 90%. Now, unsecured loans are not backed by collateral. The traditional one is a credit card loan. Now, the rate of interest that they charge for these is generally higher than that of secured loan because it lacks collateral and therefore poses a higher risk to the lender. The bottom line is if you go and get a credit card, from Wells Fargo, I'm trying to be an equal opportunity offender as I talk about banks, and they give you a $5,000 credit limit and you go out and take a trip to Las Vegas and you charge it up. Maybe you play some slots, whatever you like to do. Maybe go for a tour of the Hoover Dam, whatever's out there. I've never actually been there myself, but let's just say you do that. And then that bill comes due and they say, "Oh, okay, it's interesting, Mr. Owens. I see you owe us money on your credit card." And you're like, "Well, guess what? You can't get blood from a stone, my friend." And there's really nothing they can do. Well, of course, now they can take you to court. They can attach your wages and things like that. They can, mess up your credit, but there's nothing they can come and get. They're not going to come and get anything because it's a credit card. It's a sign and hope you pay me back loan. And that's why the interest rates are higher. You're talking about a car loan maybe at 4% and a credit card loan at 14%. That's because there's a higher risk. Now, Within the unsecured loans, there are really two types. And this is true for secured loans as well. Open-end credit and closed-end credit. I want to take a few minutes to talk about this because a lot of people don't understand this. An open-end credit, also known as a revolving credit, is a credit instrument that does not require fixed payment each month. This is your typical, credit card. You've got a credit card with a $2,000 credit limit. It doesn't require you to make a fixed payment. They may have a minimum payment you have to make, but it's not a fixed payment. And the interest is charged on whatever your unpaid balance is. As you pay down the balance owed, you can reborrow up to the approved credit limit without having to reapply. This is department store cards, gas company cards. I remember my wife told me a story about when she used to work, when she was younger at a department store, and she said people would come in and they would make their credit card payment. A lady would come in and say, okay, well, how much is my credit card? Oh, you have a $200 payment. Great. Okay, well, here's $200. And then they turn around and say, but I'm going to go shopping, right? I'm going to charge it back up. And so you could do that because you paid down on the $200, and now you've got that $200 back as available balance. And the problem with these cards, from a financial standpoint, these will get you in trouble because it's really easy to keep them, quote, maxed out. Now, the other type of loan is what's called a closed-end credit. This is often referred to as an installment loan. So you sign a contract to repay a fixed amount of balance owed in equal payments over a specific period of time. This is your typical, auto loan, your boat loan, furniture loan, home loans, personal loans. They're going to say to you, okay, we're going to give you that $20,000 loan for that car, and you're going to pay us back, $315 a month. You're going to pay that for 48 months. We've added the interest into it, so $315 a month, your payment. You're going to make those payments, and once you made that payment, the car is yours. We're going to give you the title. It's yours because it's a closed-end credit. They're not going to give you that expansion. So once you make 5 payments, they're not going to say, hey, you know what? Remember those 5 payments you made? Hey, you want to get them back? No, it doesn't work that way. Now, you could always refinance the car, do something like that and maybe cash out of that thing. A lot of people do that with their home loans or their home equity loans, but that's generally not the intention of these. The intention of these, it's a closed-end credit. It's a specific period of time. You're going to pay this much each month, and the idea is, you don't have a line of credit. You have just a closed-end loan. It's going to be, the starting point is this, the closing point is this. You're going to make 24 payments, you're going to make 36 payments, whatever that is over the life of that loan. But once you pay that loan off, if you want to do something else, you've got to go back and do another application and get another loan for this. Now, one of the nuances to this, and I'll talk a little bit about this because credit unions do a lot of this, and that is an open-end car loan. And I'm not going to spend a lot of time talking about it, but just be careful what you're getting into there. A lot of times, and I don't want to just throw credit unions, there are other people that do this, but take a look at, read the fine print. What is it you're getting into? Because generally, with an open end, the interest rates are going to be higher because there's more risk. With a closed end, there's less risk because they're taking a look at this and saying, okay, as you pay this down, their risk is reduced. And the idea is at some point in that loan, the value of that collateral may be worth more than what's owed on the loan. So I hope this has been helpful, and I hope you join us in our next session when we start talking about the components of a credit score and a credit report.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.